Hi everyone, this week we're going to continue on our financial risk and financial risk management, and the topic is Warren Buffett's investment philosophy and basically comparing Warren Buffett's investment philosophy to the tenets of modern finance and reconciling this is one of the greatest investors of all time, and how has he done it? What does he believe in that works as opposed to some of the proven and most tested academic concepts in finance in terms of investment management? So, I wanted to look actually at economic reality, not accounting reality. What does that mean? So, Warren Buffett says that basically the financial statements really tell you what happened in the past, right? And economic reality is telling you what is going to happen in the future. So when Warren Buffett is looking to invest into a company like Apple, he's not necessarily looking just at the balance sheet. He wants to know where's this business headed in the next 10, 20, even 30 years. And that is very interesting piece. Account for the cost of lost opportunity. I like this one a lot. So Warren Buffett talks about how it's not that you want to, should I invest in Apple or not? It's, do you invest into Apple versus Microsoft? Do you invest into Apple versus Google? And when you have a choice, you have to basically go through the idea of like, what is a better opportunity? So it has you not just think it's like, oh, this is maybe a bad investment. Then what is a better investment? What's even a better investment? And that kind of consciousness, I think, has had him select basically what would be the best investment. And oftentimes he selects these best in class companies. Um, so that is a good one. Focus on time value of money. Um, this is kind of thinking about what is ultimately driving value, and that is the present value of future cash flows. So that be grounded in that idea that whatever, regardless of what kind of asset you're getting into, at the end of the day, it's going to be the present value of the cash flows that is going to drive value creation. So focusing on wealth creation, he's talking about here about creating value, creating, could mean generating more sales, generating higher profits. Deep information analysis, that's the quantitative analysis. The alignment of agents and owners, so making sure that these companies are have management that is actually working on behalf of the shareholders. That's definitely a huge piece, that he selects the managements that are best in class, that are definitely looking to increase shareholders' wealth, maximize shareholders' wealth, but is also aligned with stakeholders like community and government as well. Using the risk adjusted, this piece we're going to see more of in our class about how he doesn't really believe that there's a certain cost of capital, a certain, say, equity risk, depending on which asset you're getting yourself into. So this is a very interesting piece where he believes that risk is not necessarily, for example, a company that has a beta of 1 in the S&P 500 would have a risk rate of 7-8%, which is the risk rate of the S&P 500, or risk premium. So he believes that different companies have different risks, which is definitely true. It's just that in academia they average them out and kind of assign them a more relative correlation to the S&P 500. So it's very interesting. It's a more detailed view of risk that is more customized to his style of investing. And then Buffett believes that you don't have to diversify because he's so good at picking investments that actually diversifying, can take your profit away. If you put your money in 100 stocks and one of them doubles, you're only going to make like 0.5% of income. So, he's like, if you know what you want, you can go a little bit more aggressive with it and not diversify away your profit. And the capital market efficiency, that theory says that all prices are really true prices of stocks. He really doesn't believe in it, thinking that there are dislocation in prices in the market that over time move toward their true price. And if you see with his investments, he's done that. He's invested in stocks that have appreciated dramatically. So by the virtue of that, when he bought them, they weren't at their true price. So capital market efficiency theory is not always right, but in the averages of averages, it is right. If you average everything out, all the prices are always correct at the time that you view them. But Buffett is able to see sometimes undervalued assets and take advantage of it. So these are the tenets of modern finance and Warren Buffett's investment philosophy. And this week we're going to be with his philosophy, and see how it can be applied to investment and investment analysis.